What if I told you you don't need 10 indicators, 4 monitors, and 10 Telegram groups telling you when to buy or sell? Trading, when it comes to trading, simplicity over complexity. And that's why for today's video, I'm going to be giving you 3 trade setups that are simple yet effective that you can use for futures trading and sports trading. So I know you want this alpha. You know what to do. Watch this video from the very beginning up until the very end. And with that out of the way, let's jump right in. So welcome back to VC Crypto Gist, where we talk all things crypto and we break it down so even your grandma can follow along. And to ensure that I don't forget any important points, we have our trusty tablet here with us. So now let's just jump right in. So now the issue when it comes to execution of trades for a lot of beginners and even up to the professional level is that most people have not yet defined what is a valid trade, when they are wrong, where they are wrong, and how much they are willing to lose when they are wrong. And these are things that each and every trader should have built into the setups they are actively trading. Before the setups, let's first understand something. A high probability trade does not often mean a guaranteed trade. All right. As a trader, you are managing risk and you are trading probabilities. The probability that this trade may go in your favor does not automatically guarantee that that trade goes in your favor, all right? First and foremost. So imagine you have a strategy that wins 50 to 60% of the time, right? That means out of 10 trades, you are going to win on average 5 to 6. But simply because your strategy has a 50 to 60% win rate doesn't mean you automatically keep winning 5 to 6 trades out of 10. Hope you understand that. All right. The difference between win rate and expectancy, understanding that difference is often what separates profitable traders from unprofitable traders. And now that you've properly grasped that, let's go to the first setup. So the first setup, that is simple yet effective, I see so many successful traders online and offline use this strategy, is the breakout and retest. This is probably one of the easiest setups ever, and it is so simple. So basically, there is support and resistance, and of course, you should know what support is. Support is the level that supports price from going down lower, and resistance is the level that resists price from going up higher. So now, let's say BTC is at a support level of $50,000. BTC has repeatedly come down to this level 4 to 5 times. When you see that, it is obvious that BTC is knocking on the door of $50,000 and it wants to desperately go down, right? So now, what usually happens is when the price goes down below, everybody immediately enters the trade there, and that is where they get it wrong. Price levels in markets often do one simple thing. They break a level, they come back to that level to retest that level, either as new resistance or to reclaim it back as support. So now let me not deviate much from what I have here, right? So let's say, imagine Bitcoin has tested 50,000 4 times and keeps getting supported. That makes 50,000 support. Eventually, Bitcoin breaks below it. Most beginners immediately press sell, and sometimes Bitcoin says thank you for your liquidity, and price reverses back up aggressively just to flush everybody out. What you should do is, instead, you should wait for 3 things to happen. You want price to break. You want to see a convincing move below the support region. You want to see a retest to see what price has ultimately decided to do, if it wants to come down, if it wants to continue lower, or it wants to just go back into the zone and start moving upward. 3, you need a confirmation. Now you need to look for buyers to either defend the level or for sellers to take control of the level, which will push price down to close below the level. So let's say BTC goes above 50,000 after breaking down. You want to see whether the buyers are going to continually step in to take price higher, or the sellers are going to push price down below 50,000. All right. You can wait for any confirmation of your choice. It can be a bullish engulfing candle, it can be a rejection wick, increased volume, or a lower time frame market structure shift. That is your potential entry. And your stop loss, this is where a lot of people get stop loss placement wrong. Don't place your stop loss at a round figure or where seems convenient. You want your stop loss to be where the trade is invalidated, meaning that trade no longer makes sense to be in. So your stop loss should be at that level so you get kicked out once the trade is invalidated. You can have your entry when price comes back above 50,000. You can okay, if you are seeing more sell side volume but price is still above 50,000, you can have your entry at, let's say, 50,500, 50,300. If the structure starts to shift at around 50,800, that is where it makes sense to have your stop loss, not at like, let's say 50,005 where everybody's keeping their stop loss because it actually makes sense and is a round figure. Nah, you don't want to do that. So this is one of the easier setups, and it is called, hold on, the break and retest trade setup. So now let's quickly move to the next because of time. So now we have what we call the trend pullback, and I have used this trend pullback strategy personally to make a lot of money. Even last month, I actively used this strategy. All right, this strategy, as simple as it is, a lot of traders have used it to sabotage themselves, and now I will briefly explain. So now, let's say Bitcoin pumps 12%, everyone suddenly becomes bullish. All right, then they buy, and Bitcoin retraces 6-7%. You see the issue, and suddenly everybody is a macroeconomist, everybody is an analyst, explaining why trees are green and why there is war in the world. Meanwhile, they were not focusing on the two simple things that markets do when they are trending in either upwards or downwards direction, which is higher highs and higher lows, lower highs and lower lows. Now, when Bitcoin pumped 12%, that will give us a change in structure, right? Or a continue, or a break of structure, which continues the overall trend and structure, right? So now when Bitcoin does that, it's going to establish, a higher low, sorry, rather. The 12% is the higher high, then coming down 6% is the higher low. That higher low is where you should target to enter. And what makes it beautiful is there is a concept of fair value gaps where price goes up in a straight line. There's a fair value gap there. Price often retraces into that fair value gap to establish the higher low and then continue the dominant trend. But people just jump on the actual trend and get liquidated or stopped out, and then the trade continues and they say, oh my god, market is rigged against you and all of that. So you don't want to be that guy. So now, this is how you should play the trade. Mark important areas such as your previous resistance, demand zones, moving averages if you use them, Fibonacci retracement areas, which are also very important, all right, and previous structural low. So now, previous structural lows, So now, this is how you should play it. Let's say price has started moving up. Take your Fibonacci retracement tool, place it at the top of the let's say put it at the peak of the higher high, and then pull it down to where the trend initiated from. You should be targeting between the 236 and the 618 levels for a very good entry, and then below those levels should be support regions, in the sense that when price comes down that low, the trend would have been invalidated to a very high degree. All right, so you don't want to be jumping when it's going up, and you should also use your support and resistance levels in confluence and other areas. You want harmony between everything you're watching to enter a trade. When you get your entry, you go into the trade. Whatever risk to reward ratio is actually good for you. If it's 3-1, 2-1, 5-1, and for the snipers out there that are targeting 10-1, you know how you enter, where you position your stop loss, and yeah, it's a very, very, very good trade to take. Because I remember taking a trade on Bitcoin Cash because it has been trending down, it has been oversold. So I was expecting a shift in trend. So price spiked up a lot. I got some early entry in the trade, managed the entire trade, took some profits off early because I knew it was still going to crash down. It came back down, then I added and added and added, and 2 to 3 weeks later it exploded, took my profits, and that was the end of the trade. So now we're going to go to a slightly more technical setup, which is actually our third setup on the list, which is called liquidity sweep and reversal setup. Now let me explain this setup, all right, because this one is slightly more advanced. Have you ever placed your stop loss just below support, like in the first setup when I was explaining? You don't just put it at a like round figure or an obvious support or resistance level, and then price will hit your stop loss and then immediately reverse, and it's thanking you for your liquidity and contribution to the market. Cheers. What you have experienced there is called a liquidity sweep. Now, obvious highs and lows tend to attract orders and create this cluster of orders, which then form order blocks at certain levels of price. Now imagine Ethereum has equal lows. It has bottomed out twice at $3,000. Thousands of traders may have stop loss sitting, let's say, around 2,950 or lower. Then price briefly drops to 2,900, and then everybody's stop loss gets triggered, and then it immediately reclaims 3,000 and starts moving upward. Instead of blindly buying the first dip below support, wait for the reclaim. The sweep itself isn't the signal. The market's reaction afterward is. So now what you want to look for is you want to look that, okay, the cluster of liquidity at the level you are watching has been taken out. So the market has no business going towards that direction because the market and price moves in a direction of liquidity. All right. So you want to ensure that your orders and your stops have no business being on the side of liquidity. Now, this also ties into the trade I took last month. So now let me explain using that lens. So BCH is at $200. I can see a huge cluster of liquidity at around 220 to $230, all right? But price is not moving in that direction initially because one, the trend has not shifted completely. Two, well, we have huge liquidity sitting around 190 to 180. So what did I do? I got a small position earlier on in the trade. Price moves upward. I captured some profits on that, but I'm waiting for price to take out that liquidity below. After price had taken the liquidity below, when price started to slowly move back upwards, I kept on building my position and building my position and building my position. As at the level I wanted us to reclaim, I gave myself a time frame. If we did not reclaim this level and balance out there and get to an equilibrium, I'm not going to like continue the trade. I'm going to close it and all of that. Price took out the liquidity below, established the new support, started grinding upward slowly, and then it exploded immediately when BTC started trending up. So you have to look for the market to take out the liquidity. You want a strong reaction. You want the level to be reclaimed, and then you want the market structure to either shift in a bullish or bearish posture depending on the trade you are considering. Now you have a potential reversal setup because of the liquidity sweep and the reversal. So I'm going to add a bonus part because a lot of people skip this part because it's boring. But this is the part that either makes or breaks you as a trader. So now, here's the uncomfortable truth. A mediocre or an excellent strategy without risk management can survive. But a mediocre strategy and excellent risk management will survive. Let's say you have $1,000, you're risking 1% per trade, all right? That doesn't mean you only put $10 into the trade. Your position size depends on the distance between your entry and stop. And with futures, leverage does not magically create better opportunities. It simply changes your exposure and liquidation risk, all right? Before every trade, you should know where you are entering, where you are going to be invalidated or wrong on the trade, how much you are risking, where you are taking profit, and your risk to reward ratio. If you cannot answer those 5 questions, you do not have a trade. So, what you have on your hands, my good sir and madam, is a gamble. So, in essence, your trading needs risk management to survive. I would focus more on my risk management, my psychology as a trader, and my own emotional regulation more than a strategy because you can piece any strategy together to have like 30, 40, 50, 60% win rates. You tweak your risk to reward ratio. But what ultimately makes that strategy to survive is your risk management. So you cannot afford to do it without risk management. So now let's quickly recap everything we have learned. In step one, you have your breakout, retest, and confirmation for your breakout trades. For your step two, setup two rather, which is the pullback. Yes, that should be the pullback, the trend reversal of this thing, yeah. Trend reversal setup, which is the pullback setup basically. So you want to have your established trend, you want the pullback in the trend to establish, sorry, either the higher low or lower low. So you want the trend to already be established, you want a pullback in the direction of the trend, you want confluence and continuation. So you enter on the pullback, get your confluence around the pullback, and then you enter and ride the continuation of the trade. Then we have the liquidity sweep where you wait for market to sweep obvious liquidity, reclaim, establish support or resistance, and then you have your reversal confirmation. In order for you to benefit and get the most out of these three, you need to know your position sizing, risk tolerance, your invalidation points, and also have solid risk management. Now, none of these setups will win all the time. Of course, they are not guaranteed. Even in last month, I made reasonable amounts of money trading. I also made losses too, but my profits outweighed my losses. So You don't need to predict every trade or get every trade 100% correct. All you need to do is win more than you lose. And I hope this has been helpful. If this has been helpful, insightful, you know what to do. Share with your friends, and I'll be seeing you in the next one. Peace.